If you're retired or you're about to be, there's one decision that will quietly affect almost every other financial outcome in your entire life. Do you know what it is? It's not how much you saved. It's not which investments that you own, although those things are important, but it is the order in which you withdraw your money. Most people think retirement planning is really just about building the portfolio, and then once you do that, you're done and mission accomplished. But once the paycheck stops, it becomes about engineering income. And engineering income requires coordination. If you're within 5 years of retirement or you're already there, this question becomes absolutely critical for you. Where should your income come from first? And before we get into it, my name is Will Snodgrass. I'm a CFP and the owner of Matt25 Capital. We're a Christian wealth advisory practice, and what I'm sharing today is meant to be really educational because every situation is different, and nothing here is individualized, but it's good high-level information I think you should know. So let's kind of talk about what actually matters. Most retirees have assets in three primary categories. One is tax-deferred accounts, and think things like traditional IRAs, 401ks, 403bs, things like that. Taxable brokerage accounts, and then tax-free accounts, typically like Roth IRAs. Each of these behave differently from a tax perspective, and that's really important and critical because that's what is most key. Retirement income is not just about generating dollars, although we are sensitive to those things. It's about generating dollars in the right tax order and being proactive with your tax planning. So here's the first major issue most retirees miss. Tax brackets don't stay the same. Your bracket today may not be your bracket at 75 or 80 or 85. And if you ignore that reality, you can unintentionally create a future tax compression problem. Let me kind of explain what that exactly means. So if you retire at 62 and you avoid touching your traditional IRA because you don't want to pay taxes, that account may continue growing for an additional 10 years or so until you have to start taking RMDs, because at 73, required minimum distributions or RMDs begin. Those RMDs, though, are not optional. You are required to take them. And if the account has grown substantially, those required withdrawals can push you into a higher tax bracket, whether you really wanted them to or planned for them to or not. And that's not bad luck. I don't even believe in luck. That's deferred coordination. Withdrawal order is about managing that timeline more intentionally and proactively. So here's another piece most people will sometimes overlook. Social Security taxation. Up to 85% of your Social Security benefits can become taxable depending on your total income, and the threshold's actually pretty low. Many retirees accidentally trigger taxation simply because they stack withdrawals in an inefficient manner. So here's another example. Let's say you withdraw heavily from an IRA. That increases your adjusted gross income. That then pushes more Social Security into the taxable territory, whether you meant to or not. Now you're paying tax on dollars you assumed were going to be fixed income. The order of withdrawals changes that equation. So let's now layer in one more thing, which is Medicare. Medicare premiums are income-based, whether people realize them or not. There are income thresholds known as IRMAA brackets that can significantly increase your premiums if you cross them. And those brackets are what we call cliff-based. That means one extra dollar of income can push you into a higher premium tier. That's not theoretical, by the way. It happens literally all the time, whether people mean to or not. So if your withdrawal strategy ignores income coordination, you may accidentally increase your Medicare costs for an entire year. This is why retirement income isn't just about what's easiest. It's about orchestration. Now, let's talk about Roth accounts because those are a bit different. Many people assume Roth dollars should be used first because they're tax-free. But often, Roth accounts are most powerful when they are preserved for use later. Why is that? Well, because they create tax flexibility later in your life. They don't increase your taxable income. They don't affect Medicare premiums, which is also an important distinction. They don't increase Social Security taxation, and they don't have required minimum distributions unlike traditional IRAs. That makes them strategic assets, not just spending accounts, and that is a big differentiator. So here's another layer, though, that most retirees may not think about: the widow or widower tax issue. When one spouse passes away, the surviving spouse moves from married filing jointly to single filing status. Tax brackets then will compress. The same income can now fall into a higher tax bracket without a person even realizing it. So if most of your wealth sits in tax-deferred accounts, that shift can dramatically increase a lifetime tax burden. So withdrawal planning is not just about today. You can't think of it that way. It's about the surviving spouse. So let's try and make this maybe a little bit more practical for the people watching. A thoughtful withdrawal framework typically aims to do this and other things: smooth income over time, avoid tax bracket spikes, manage IRMAA thresholds, preserve Roth flexibility for later, anticipate RMD impacts, coordinate Social Security timing, among other things. That doesn't mean complexity for its own sake. It just means foresight and being proactive with your planning. One of the biggest retirement mistakes I see isn't overspending, it's oversimplifying. People want a universal rule, whether it be the 4% rule or whatever it may be. They'll say things like always pull from taxable first, or always delay Social Security, or never touch the Roth. But retirement income is coordination. It's not about shortcuts. There are no shortcuts in life. It requires asking better, more thoughtful questions, such as, what does our income look like this year? What will it look like in 5 years, in 10 years? What happens when RMDs start? What happens if one of us passes away early? What happens if tax rates change? These questions shape your withdrawal order, and withdrawal order shapes lifetime outcomes. Another subtle point that I want to make here, though, is that retirement income planning is not about minimizing taxes just this year alone. It's about managing lifetime tax exposure. Sometimes that means different things for different people, such as intentionally realizing income earlier on in your retirement. Sometimes it can mean, though, blending withdrawals from multiple different types of accounts. It may not be one size fits all. Sometimes it means partial Roth conversions, not all of it at one time. Sometimes it means doing absolutely nothing. The strategy depends, again, completely on coordination. And so that leads me to something that also is important that I want people to understand. You don't need a complex 40-page plan to get this right, but you do need clarity. Inventory your accounts by tax category, among other things. Estimate future required distributions. Understand your Social Security start timeline. Look at projected tax brackets over time. And most importantly, stop thinking of accounts in isolation. Nobody should be doing that. They all work together. If you think of retirement as a puzzle, each account is one piece. If you move one piece without looking at the whole board, the picture completely changes. And that's why withdrawal order matters so much. It quietly can affect a myriad of different things, such as taxes, healthcare premiums, estate efficiency, survivor income, portfolio longevity, and the list goes on. And ultimately, what it's going to affect is your peace of mind. If this conversation made you realize, boy, maybe you haven't mapped this out just quite yet, that's normal. Most people focus on saving, which by and large is a great thing. Few people really focus on what we would call sequencing, though. And so if you'd like to learn more about how thoughtful retirement income planning works, you can visit our website at Matt25Capital.com. Additional contact information is in the description below, and we have lots of great resources on these topics and a myriad of related ones. As always, again, this is just educational in nature, but I want everyone to try and remember this. Retirement isn't just about building wealth. It's about distributing it wisely and efficiently. And that's where clarity really does make a huge difference. So I hope everyone got a lot of good information out of this. Again, reach out if you have any questions or need help with anything. Thanks for your time, and God bless.